Recently, at the Eastern Economic Forum in Russia, a public speech by one of President Vladimir Putin's senior advisors, Anton Kobyakov, captured global attention. He claimed, "The United States is now trying to change the rules of the gold and cryptocurrency markets. Think about how much their debt is, $35 trillion US.
Right now, America is trying to change the rules in the gold and cryptocurrency markets. Remember how much debt they have, $35 trillion.
Anton Kobyakov stated that the U.S. is allegedly conspiring to use cryptocurrencies, stablecoins, to devalue its $37 trillion of debt until it's completely written off.
Once again, in simple terms, right now they have a $35 trillion currency debt. They move it into crypto, into the cloud, devalue it, and start from scratch.
His words were, "Drive everyone into the crypto cloud." He suggested that over time, as a portion of U.S. national debt is placed in stablecoins, the U.S. will then devalue that portion of the debt. He believes the U.S. would put its national debt into this crypto cloud to reset the entire debt system, ultimately making every country and individual holding U.S. dollars pay the price. This plan sounds almost too incredible to be true, but a very important figure in the U.S. has publicly discussed a similar plan, essentially cross-validating the idea. This person is Michael Saylor, the billionaire CEO of MicroStrategy, suggested that President Donald Trump should sell all U.S. gold and buy Bitcoin to potentially zero out the U.S. national debt. Sell the gold. Here's what Michael Saylor said. Sell all the gold in the United States, and then buy Bitcoin. This way, the transaction doesn't require additional capital because you can buy 5 million Bitcoins with the cost of gold. You will demonetize the entire gold asset class, and our enemies, their banks hold gold, so their assets will go to zero. And our assets will reach 100 trillion US dollars. We will simultaneously control the world's reserve capital network and the world's reserve currency network. So the question is this plan feasible? In my opinion, it's not only feasible, but it could very well happen. It may be unavoidable, but it might not unfold exactly according to that script. Let's take a closer look at what Anton Kobyakov actually said, and explore how stablecoins and Bitcoin could be used to devalue $37 trillion of debt. The whole plan is fascinating. After I finished my research, I broke out in a cold sweat, because this could also signal the biggest wealth transfer and wealth gap of this century. We're starting right now. Welcome to Stewardship Finance Academy. We're the channel that equips you with the financial wisdom you don't learn in school, helping you achieve financial confidence. Welcome. Please like and subscribe, and turn on the notification bell by selecting all so you won't miss out on exciting updates and investment opportunities. By now you might have many questions. Don't worry, we'll answer them one by one. First, who exactly is the person who said this? His name is Anton Kobyakov, a senior economic advisor to Russian President Vladimir Putin, a position he has held for over a decade. One of his tasks is to represent Russia at the Eastern Economic Forum. He said that gold and cryptocurrencies are two alternatives in the global monetary field. The main task of the United States, he argues, is to solve the problem of declining trust in the US dollar. And it will likely solve its own debt problems at the expense of the entire world. How would this be done? By driving everyone, all countries, into the crypto cloud. Once a considerable portion of US national debt has moved to the cloud, the US could then use stablecoins to devalue the debt until it disappears. So what exactly does debt devaluation mean? Imagine the value of the entire world is only 10,000 US dollars. The total currency in circulation, used to represent all goods and services, is just $10,000. Now, imagine I borrow all of this money. Of course, borrowed money must be repaid. And it just so happens that I also control the world's most important reserve currency, the US dollar, and can create money out of thin air. So now there are two ways to repay the money. The first is to truly repay all the money I borrowed. In this case, the world's goods and services don't change. The amount of money in circulation doesn't change, and the debt maintains its original value. The second way is to print an additional 10,000 US dollars out of thin air and use this new money to repay you. The total amount of goods and services remains unchanged, but the US dollars in circulation have doubled to 20,000. If you use this money to buy goods and services, the prices will naturally double. Although you were repaid the same nominal amount of money, and it looks like you haven't lost anything, you can now only buy half as many things. In other words, the debt has been devalued by 50%. I kept my promise and repaid the money. Everything is legal, but in reality, you lost. This is what the United States has been doing, and it has done so more than once in its history. After World War II, the US balance sheet was in the red. The federal government's debt-to-GDP ratio was as high as 106%. A debt of this scale is like an endless economic black hole for any country. But the US government didn't choose conventional debt repayment. It opted for debt devaluation. In the years after the war, the government collaborated with the Federal Reserve to create sustained inflation. From 1946 to 1951, prices rose by more than 35%. The Federal Reserve kept interest rates low, and the Treasury continued to issue bonds to buy goods and services, promoting national infrastructure investment and effectively overspending into the future. Under the cover of inflation, the debt-to-GDP ratio quickly shrunk. Falling below 40% by the 1960s, the debt pressure was completely resolved. Then in the 1970s, the US entered a period of stagflation, with a stagnant economy and high inflation. The oil crisis, coupled with the Nixon shock in 1971, when the US dollar was decoupled from gold, directly unleashed the speed of dollar depreciation. Inflation soared into the double digits. People's wallets shrank rapidly. In 1980, prices rose by 13.5%, and mortgage rates easily exceeded 10%. But the government's debt burden actually decreased because, in a high inflation environment, the real value of the principal being repaid by debtors was greatly diluted. This was equivalent to turning debt into an inflation tax borne by the entire population. Fast forward to 2020. During the COVID-19 pandemic, the economy was severely hit, giving rise to the latest and largest round of debt dilution. The Federal Reserve and the Treasury acted with unprecedented force, launching trillions of dollars in quantitative easing and stimulus packages. The result was an unprecedented surge in circulating US dollars, followed by a carnival of asset bubbles in US stocks, real estate, and cryptocurrencies. The federal government's debt surged from $23 trillion before the pandemic to nearly $33 trillion. A new historical high, yet, under the pressure of creditors worrying about default, the actual repayment burden was hedged by soaring inflation. By now, you should realize that the debt devaluation discussed by Anton Kabakov is nothing new. It's a strategy the US has used repeatedly. But what if this debt devaluation is pushed to the entire world, making all people and countries pay the price? That's what some believe stablecoins will achieve. Of course, I'm not saying all $37 trillion of US debt would be converted into stablecoins. The US dollar can exchange one-to-one with stablecoins, and stablecoins are backed by national debt. If the US dollar depreciates, the cost of US debt can be distributed globally through stablecoins. We'll talk more about this later. For a moment, calm down and imagine a world where inflation shouldn't exist. The normal economy should be in a state of deflation. Let's go back to our previous example. Suppose there are only 10,000 US dollars in the world, and that amount is constant. But with technological progress and increased productivity, the total goods and services produced will increase. That means the same $1 US could buy more things, or it would cost less money to buy the same things. If there were no government intervention, the economy might look like this, with prices getting lower over time. But the world we live in doesn't operate this way. Why? Because the government can create more money out of thin air. After new money is created, you'll find that gold, stocks, real estate, and Bitcoin are all rising in price, with some reaching historical highs. But have these things really increased in value? Not necessarily. The real reason is often the depreciation of the US dollar. Because there are more dollars in circulation, it takes more of them to buy the same things. And when more currency enters the economy, that liquidity needs to find a reservoir, because no one wants their money to depreciate. So, money flows into stocks, real estate, gold, and cryptocurrencies. In the long run, these assets appear to be appreciating, but in fact, they may just be maintaining their value. The currency representing those assets is what is becoming less valuable. If this logic and influence were to be applied to the whole world, many believe it would have to be achieved through stablecoins. So the question is, if the US can use inflation and currency depreciation to resolve its debt, why bother with stablecoins? This is also what Anton Kobiakov wanted to explain. The answer lies in the distribution mechanism and control. The core value of stablecoins from this perspective is their ability to export the inflation burden globally. In the traditional model, using an increased supply of US dollars to dilute debt causes people to immediately feel price increases. Then, interest rates rise to fight inflation, mortgage rates go up, and the cost of living increases, making life harder and potentially triggering political instability. With stablecoins, this problem could become smaller, even negligible. Because some people would use stablecoins, it would create a continuous demand for US dollars and national debt. These stablecoins are backed by short-term US national debt. As long as someone uses stablecoins, it's equivalent to indirectly buying US debt, providing support for issuing even more. Once US dollar stablecoins become widely adopted, they could effectively expand the demand for US national debt, forming a self-reinforcing loop. If the US dollar depreciates due to inflation, all individuals and institutions worldwide holding these stablecoins would jointly bear the loss of purchasing power. Inflation then becomes a shared tax paid by everyone using stablecoins globally. This would disperse the pressure of debt devaluation, somewhat like today's traditional US dollar system. But stablecoins will eventually appear in everyone's mobile electronic wallet. and their influence could be infinitely magnified. At the same time, stablecoins can also obscure their political nature. Why? Because stablecoins are issued by private enterprises, not the US government, Treasury, or Federal Reserve. Compared with central bank digital currencies, CBDCs, private enterprises issuing stablecoins present many advantages for this strategy. For example, a proposed bill, the Genius Act, or similar legislation, could stipulate that as long as banks or private enterprises are approved, they can issue compliant stablecoins. Tech giants like Apple or Meta could create their own stablecoins without direct political sensitivity. By maintaining a good relationship with the administration, they might gain approval. This would be like having no central bank backing, but achieving central bank level regulation and control. The US wants the world to accept US dollar stablecoins, but will they? Many analysts say absolutely not. Most don't even want to touch them, because the whole world is hoarding gold. Major countries are all doing it, essentially saying, we don't want stablecoins, we want gold. Because gold has been a universally accepted standard of value for thousands of years. So why gold? Although stablecoins are backed by US dollars in debt, the problem is that no one can independently audit them. Although stablecoin issuers like Tether or Circle claim their stablecoins are one-to-one backed by real US dollar assets and regularly publish audit reports, a foreign government has no way to be 100% certain. Trust relies entirely on US-based issuers and auditing institutions. In matters involving national asset security worth trillions of dollars, this just trust me model simply doesn't work. This isn't just suspicion, there are historical lessons. In 1971, the Nixon administration unilaterally severed the US dollar's convertibility to gold. Decades of rules and promises were invalidated overnight, overthrowing the Bretton Woods system. The lesson is clear. The US can unilaterally change the rules at any time for its own benefit. Therefore, from the perspective of other countries, current promises about stablecoin asset backing could easily be overturned in the future if needed. This is why many are unwilling to follow the US and adopt a stablecoin system. The next question is, how will the US promote a stablecoin system? Or are there alternative solutions that could achieve the same goal of debt devaluation? In my opinion, such solutions not only exist, but they may already be in the implementation stage. Michael Saylor, the billionaire CEO of MicroStrategy, suggested that former President Donald Trump establish a national Bitcoin strategic reserve. First, he proposed massively selling gold on the market to suppress its price, devaluing this traditional asset. This would severely shrink the balance sheets of countries that use gold as their core reserve asset, such as China and Russia. At the same time, the US would buy a large amount of Bitcoin, dramatically pushing up its price and establishing Bitcoin's status as a global reserve asset. By doing this, the US would shift from the old gold system to a Bitcoin system and continue to dominate. This also has a side effect. The price of Bitcoin would be expected to rise exponentially. According to Michael Saylor's vision, its value could reach the quadrillions of dollars, fundamentally solving the US debt problem. However, this vision has not yet been realized. US government has said it will not use taxpayer money to buy Bitcoin, effectively rejecting the proposal for now. So this matter will not develop as Michael Saylor envisioned in his interviews. But that doesn't mean alternative paths don't exist, because the US government may already be experimenting with an entirely new strategy. Private agents. The government indeed hasn't been openly buying Bitcoin, but many private companies are. For example, MicroStrategy has been continuously buying Bitcoin for the past few years and now owns hundreds of thousands of coins. Is it possible that the US government is tacitly allowing these companies to buy large amounts and accumulate Bitcoin? It doesn't look like a government or central bank action, so few people pay attention, and no one associates it with the US government. After Bitcoin becomes a reserve asset, when the time is ripe, the US government could then buy shares in companies like MicroStrategy through the capital market. There is a precedent for this kind of operation. For example, when the US government bought a major stake in Intel, it's somewhat like an American version of private enterprise nationalization. Why would they sell all their gold and buy Bitcoin on the open market, causing such a big stir? It may be easier to just let private companies operate first and test the waters. If it's feasible, the US government can intervene later. This is a game the US government has often played. Let the private sector innovate. And when the innovation develops to a certain extent, the government intervenes until it can no longer be ignored, and then officially acknowledges it. It's just like it didn't acknowledge Bitcoin for years, but now officially does. So, the Russian economic advisor, Anton Kobiakov, may be right. Because there appears to be no other way to resolve the US's $37 trillion debt. The whole world may have to pay for it. Any economic policy ultimately depends on how it affects the lives of ordinary people. If this crypto reset plan is actually implemented, the most direct result would be an unprecedented large-scale wealth transfer from ordinary office workers and the middle class to those who hold large amounts of assets. And these transfers are invisible and difficult to reverse. Let's first talk about those with many assets. Their wealth is mainly in stocks, real estate, and gold. When inflation comes, the prices of these assets tend to rise, and their book wealth increases accordingly. In a crisis, they can actually profit. Now look at office workers. They mainly rely on fixed wages. Inflation will severely erode the real value of their wages. Things become more expensive, but income doesn't keep up, and living standards decline sharply. The government always has to protect itself first. Ordinary people may ultimately pay for fiscal problems. Understanding this major trend, we cannot afford to wait passively. We must actively adjust our strategies. Faced with such systemic changes, individual investors cannot influence government decisions. Executing a strategy is more crucial than choosing which assets. Transforming savings and income into quality assets that can preserve and increase their value is the only defense. For example, stocks or index funds. Real estate, as a tangible asset, usually sees its price rise with inflation. These are classic anti-inflation methods. Gold is a traditional safe haven. When people lose trust in fiat currency, its value emerges. Central banks around the world are increasing their gold holdings, which already proves this point. Bitcoin's volatility is relatively high. But in a world where fiat currency is being eroded, it has significant potential for appreciation as an emerging asset. If you want to learn how to build a resilient portfolio and navigate these uncertain times, check out our free stock investment masterclass. It's a great opportunity to deepen your knowledge. The link to sign up is in the description below. However, choosing assets is just the starting point. Ultimate success depends on your decisions, including when to sell. Welcome to leave your comments below the video. If you want to keep up with financial news, improve your mindset, and achieve financial freedom, don't forget to subscribe to the channel and help me by liking this video. See you in the next video.